Well, good morning, everyone, and welcome to the latest iteration of our quarterly economic and market updates with our Chief Economist, David Bassanese. My name's Blair Modica, and today we're going to be discussing navigating the narrow path with David. So looking forward to getting stuck in and having a good conversation. Before we begin, it's important just to note that all information in this presentation is general in nature and doesn't take into account anyone's personal financial circumstances. If you do have questions on personal financial circumstances, please see a financial advisor. And just before we begin, some little housekeeping notes. A recording of this session will be sent around generally later on this afternoon to everyone that attended and will be available immediately after on our YouTube channel. More than happy to take questions throughout the presentation and we'll get to them at the end. You can ask a question during the session via the toggle on your screen, and we will have plenty of time to answer them post the presentation today. So a little bit more information on our regular content. There's plenty of information on our website, blogs, fund data, and certainly investment information. Our regular insights pieces are well circulated. You may be familiar with our Bassanese Bites section put together weekly by David. And we always welcome social media followers, so Facebook, YouTube, Instagram, LinkedIn, and X, or Twitter as it was formerly known. Just a little bit about Betashares, now 28 billion or just over 28 billion in terms of funds under management and over 80 products in the marketplace. So the only Australian founded and managed ETF provider, 130 of us or more than that now across Australia, and 5 offices across Australia and New Zealand. So, you know, really proud to be able to work for a business that has a range of products that are relevant for the Australian investor. And today, it's my pleasure to introduce David, our Chief Economist. David, I won't go into too much detail on this slide, but I'll hand over to you and look forward to having a good discussion.
No worries, Blair, and thanks, for being here. Thanks, everybody, for joining us again for the latest quarterly update. As always, a lot happening in markets, and just to cut to the chase, I mean, I think you know, some signs of good news, some signs of hope that, you know, worst case scenarios for the US or for the global economy and the Australian economy could be avoided. And I'm going to dig into some of the reasons for that in this presentation and what that means for investment markets. So if we just, so I've really broken up the presentation today. Firstly, the Aussie economy and the RBA. Obviously, there's an interaction there in terms of what the RBA is trying to do to the economy and how it's faring under the onslaught of higher interest rates. Miracle on Wall Street. And so this is the idea that, you know, this hard landing, soft landing debate that we've been having since, well, really since the Fed started raising interest rates early last year. And there's just some signs that, you know, maybe the fear of a hard landing or the need for a hard landing could be avoided, and I'll dig into some of those reasons as well, and then look at some of what that means for bond markets, equity markets in conclusion. So firstly, just with the Aussie economy, first and foremost, I mean, good news here is that you can see the various measures of inflation are rolling over. I think we can pretty confidently say that we've seen the worst of inflation. It peaked late last year. The quarterly number, as you can see, is down to 6% year on year. We do get the monthly number, which had ticked down to 5.4% in the recent months. So it does suggest, you know, that there's further downside on the inflation numbers. And if you look at the trim mean, so that's the underlying measure of inflation in Australia, you know, also not falling as quickly as headline inflation. I mean, lower food, lower energy prices in particular, on the back of oil prices falling through last year after, you know, the spike following Russia's invasion of Ukraine has helped drag down headline inflation, but even underlying inflation is coming off its peaks. And, you know, broadly what we're seeing is that goods inflation that spiked when we had the lockdowns and everybody was buying stuff on Amazon. and there was a lot of supply chain bottlenecks with shutdowns in Asia at the same time as everyone in the West was demanding stuff. You had a spike in goods, and that's coming off. Seeing housing construction costs come off as well. The lingering issue is services sector inflation and wages growth. But I think there's some grounds to think these areas are going to fall. Will certainly at least be offset by declines in other areas, particularly goods. So just on that again, we did get a better than expected June quarter CPI. That the number came down at 6%. I think the RBA was expecting 6.25%, and as a result, the RBA was able to leave rates on hold at the August meeting for the second month in a row. And if you look at market pricing, I'll touch on later. I mean, the markets are sort of thinking we are close to the end, and I think that's probably a reasonable expectation given what we're seeing on the inflation front. Now, meanwhile, on the economy front, I mean, so inflation's rolling over, it's past its peak, it's moving in the right direction. At the same time, we are seeing evidence the increase in interest rates is starting to slow the economy, not unduly at this point, but nonetheless slowing it again to suggest that the RBA should be comfortable in terms of what it's done and what won't probably need to do a lot more. So firstly, capacity utilization. This is a measure from the NAB business survey. Look, it's still at a high level, a bit like the unemployment rate is still at a low level, but at least it seems to have come off from its peak. So that's encouraging. But I do, as with the US, as with the unemployment rate, we still are operating at a high level of capacity in the economy. In terms of the labour market, you can see here, we're still punching out reasonably good employment growth, helped by the fact that the working age population has ramped back up, as you can see on the second slide there. The reopening of immigration has meant that, working age population growth is strong. Running at something, around about 50,000 a month now. So we need 50,000 jobs growth just to basically employ everybody that is seeking a job. If we don't get that, then the unemployment rate will start ticking up. But at the moment, as you can see, the employment demand has broadly been strong enough to absorb workers. Such that the unemployment rate is still relatively low at 3.5%, has not gone up yet. And I guess another healthy sign for the overall economy is that labour force participation, as you can see there on the bottom left, is at record highs. So it's not that, unemployment's not low because there's a lot of, disguised unemployment, a lot of people out there that are given up looking for a job. And it's far from that. It's, anyone who wants a job, or many people that want a job, are out there gainfully seeking one and are being successful in finding one. So it's an overall pretty good situation in the labour market at the moment. Now, so they are we're starting the slowdown in the economy from a position of high capacity utilization, according to businesses, and low unemployment. So we do need to slow given that situation. Now, first and foremost, this is a chart of consumer spending. You see the dotted line there. I guess a couple of quick points to note. You can just see the volatility of consumption due to the lockdown. So prior to 2020, there was this is the level of total consumer spending in the economy. So look, it goes up and down 1%, 2%, one quarter to the other, but it's pretty, not too volatile. But you can just see the collapse we saw in 2020. And then the collapse we saw in mid-21 with the second round of lockdowns. But encouragingly, we had that V-shaped recovery in spending once the lockdowns ended. And so through late 21, early 22, the economy was underpinned by pretty strong consumer spending. Just in the last few quarters, you've seen a flattening off in spending for two reasons. A, look, we're basically back to trend. So a lot of that strong consumer spending was pent-up demand due to the lockdowns, and once that demand had been satiated, then consumption should ordinarily level off, and that's, I think, a large part of what we're seeing is just a leveling off in spending after it picked up following the lockdowns. But secondly, you can see real income, so disposable income, that's real disposable income, has been falling since 21. We had that a very strong surge in early 2020, as you can see, due to the government handouts and JobKeeper and the like. Then we had another mini boom in 21, again associated with the lockdowns. But the rise in inflation that we've seen since 21 has been stronger than the rise in wages, and overall disposable income has actually been falling. The absolute level of disposable income has been falling. So that's been because inflation's picked up, so it's hurt real incomes. Also, the increase in interest rates has been a factor. So net interest payments have gone up, and also the government doesn't like to talk about this, but the tax take is also going up. So fiscal drag has been an element in the slowdown of consumer spending. We've seen households spend. So households have been trying to keep their spending up, notwithstanding the decline in income. And you've seen the household savings rate, which initially spiked higher in 2020 and it spiked higher again in 21 when, again, we had the lockdowns, people couldn't consume, they got this income, so savings went up, but they've been running down their savings ever since, and that's been somewhat supporting of consumer spending. Just another way to look at that, again, just to put the headlines are dominated at the moment by the retail recession, the slowdown in consumer spending, and certainly higher interest rates are having an impact in doing that. But I think just to put it in context, if you look at real retail sales, so that is retail sales in real terms, so deflated by prices. And you can see that in the last 3 quarters, December, March, and June, retail sales have been falling. That's the top line in orange. But it's coming from a very, very high level. I mean, we had a major spike through 21, 22, so that relative to the pre-pandemic trend, real retail sales were well above that trend. So in a way, what we're seeing again is a bit of a slowing back to trend after we gorged on retail goods coming out of lockdown. And we've seen also, just if you break down consumer spending within the national accounts, I've got the dotted orange line there. So that is goods consumption, and the dotted grey line is service. So what we saw in 22, so part of that decline in retail spending, which is dominated by goods. There are some services in retail sales, but it's mainly goods. Has been a shift back towards services from goods. As you can see, as evident when you split up consumer spending in the national accounts. So through 22, consumer spending, services spending was bouncing back very, very strongly. At the same time, goods demand was starting to climb back to its trend. So various reasons to explain what we're seeing. Overall spending is coming back to trend. It's been dragged down also by the decline in income and the increase in interest rates, but also within the retail sales area and the goods area, there's been added negativity because part of that weakness is the rotation back towards services, as we're seeing from the dotted grey line there. But nonetheless, the outlook is for continued relatively muted consumer spending. Interest rates are staying high, and that's going to underpin further soft growth in the economy. Having said that, I mean, if inflation does fall, it is going to add to help support real income. Again, falling inflation is actually a positive for real growth because it's going to boost real income. So it may well be that consumer spending holds up a little bit better than we fear. But if it's due to falling inflation, then again, the RBA won't get too worked up about that because it's a positive. If it's strong and that adds to inflation, then that would be a concern. But if it's bounces back because prices are falling, then the RBA can sort of look through that to some extent. Other areas, so like I mentioned, like the labour market is tight, unemployment is low, but some forward-looking indicators of employment are falling. So you can see there in red, in orange at the top, ANZ job ads have been declining over the past year. The NAB employment index comes from the National Australia Bank monthly business survey. That's off its peaks, back towards zero. Look, these are still not at recessionary levels, but and they're still at reasonably healthy levels. But nonetheless, that decline that we're seeing, should be consistent with some slowing in employment demand. And given the ongoing increase in immigration and working age population, it should filter through to a lift in the unemployment rate, probably over the next 3 to 6 months. But again, it's been pretty surprising that it stayed very, very low. But I think when we meet next time, I'd be surprised if it's still at 3.5%. I think it might be 3.7, maybe even 3.8%, but we'll see. The other driver of the slowdown in growth, of course, is consumer spending. Sorry, not consumer spending, dwelling construction. So again, the orange line there is dwelling construction in the national accounts. And the grey line is monthly building approvals. That's both for standalone homes, so approvals to build new standalone homes and high-rise, multi-construction apartment blocks. You can see it's volatile on a month-to-month basis. It's jagged, bounces around, particularly given approvals for apartment blocks, depending on whether there's a lumpy new set of approvals or not. But nonetheless, the broad trend is down following that mini boom that we had during COVID, when the government gave a lot of subsidies for first home buyers to go out and build a new home, and that's come off, supported by higher interest rates. And there's a lead relationship there. So given the decline in building approvals we've seen to date, it's likely we're going to see further declines in housing construction over the coming year, which is going to help slow growth. And so there's been no, real change in that sort of trend at the moment. Just in terms of weakening confidence. So again, business confidence, this is a measure from the NAB survey. The long run average there is in the dotted line. And business conditions, look, they're off their peak, but they're still, a little bit above long run average levels. So again, the overall economy, yes, it's slowing down, but it's certainly far from recession based on what we're seeing in terms of business conditions. Look, what does look more recessionary, of course, is consumer confidence. And I've got the Westpac measure there of consumer confidence, basically wallowing at recessionary lows, at the lows that we've seen, close to in past recessions, which again is consistent with some slowing in consumer spending. Households are very, unhappy by the increase in inflation. They feel the pressure on budgets, and particularly those with a mortgage. I mean, as I've pointed out in the past, one of the, I guess, the challenges at the moment is that those with a mortgage, those with high debts, those on lower to average incomes are feeling the most squeeze from what the RBA is doing. Those better positioned, without too much debt, asset rich, money in the bank, have actually benefited from the increase in interest rates and are outspending. So we've got one group of households under pressure and another group of households still spending. And as I've said before, the irony of all that is that if those that are well placed to spend keep spending, the RBA has to screw down on the others that are sensitive to interest rates. If those are insensitive interest rates keep spending by a lot, given that government is doing nothing on fiscal policy, you have to screw down on those that are sensitive to interest rates. So it is inequitous in a sense, but I mean, end of the day, the RBA's got one instrument, interest rates, and it can only sort of use the instrument it's got to slow the economy. But that's a bit of a tangent, but that is the state of play with confidence. Business conditions are still at above average levels, although off their peak, and consumer confidence is weak, and that is consistent with the slowing in consumer spending. But again, with the RBA on hold, potentially on hold now for a while, inflation coming down, it wouldn't surprise me if we start to see a bit of a pop higher in consumer confidence over the next few months. The other thing the RBA would need to be, so again, summarise the conditions today, inflation's coming off, that's good. Growth appears to be slowing, particularly through the housing construction and the consumer spending area. Now, what we have seen though with the RBA pausing rates or at least slowing down the rate rises is we've already seen a rebound in housing demand. So there's the demand for existing home, that's housing approvals for existing homes has turned around. Haven't yet seen a turnaround in demand for newly constructed homes or those wanting to be constructed. But in the existing home loan market, we have seen a rebound in demand. And as a result, we've also seen a rebound in house prices, something like 4% rebound from the lows of February, March. And again, the RBA, it's not going to raise rates simply because house prices have stopped falling, but it's obviously something it will be watching. If house prices continue to rebound strongly with the RBA on hold, and that in turn encourages, a decent rebound in consumer confidence and more spending through the wealth effect, then all else constant, it's more likely to make the RBA want to raise rates a bit more. So we'll see. But I mean, so far at least, the downturn that we've seen in the housing market in terms of house prices nationally is about just under 10%. So certainly nowhere near the doom and gloom predictions of some of last year, and it's not even as big as the correction that we saw prior to the pandemic, when we had the macroprudential controls kick in and we had a 10% correction in housing due to the decline in investor demand. But that's the state of play on the housing market, that we are seeing a bounce back. And in fact, if you look at across the cities, it's pretty broadly based. So that's the Australian economy. What about miracle on Wall Street? So here is the case for a hard landing, and I've elaborated on this in past webinars, so I won't go through it in too much detail. Many of you have probably heard this story before if you've listened in previously. So inflation in the US, well above anything we've seen in the past few decades. Unemployment is at 50-year lows. And historically, whenever inflation has peaked, has gone up in the way it has, and we've had such a low unemployment rate, the US economy has never been able to get inflation sustainably down without some increase in unemployment, without a recession, basically. So the idea that inflation can fall all the way back down to the pre-pandemic levels of around 2% without any material increase in the unemployment rate would certainly be a huge feat. That's something we've never seen historically. The other case for that, adding to that case, is if you look at core inflation in the US, and the orange line there is core services ex housing. So just a quick, I guess maybe to back up a second. So the top line there is core inflation in the US, two measures, the CPI and the consumption deflator, stripping out food and energy costs. So it is their underlying measure. And you can see that has come down. It's come down from, in terms of the CPI, over 6% to just under 5%. And that's because goods inflation has come off in particular. And we're starting to see signs that housing inflation, which surged during COVID, and rent inflation is starting to roll over as well. So goods and housing rolling over, helping bring down US inflation. But the lingering problem is what's called services ex housing, which is about 50% of underlying US inflation. You can see there in the orange line, prior to the pandemic, it was running around about 2% a year on year. And today it's running, just ticked under 4%, but certainly higher than prior to the pandemic. And that's consistent with wages growth. And I've got two measures there, average and median wages, running at higher levels than we saw prior to the pandemic. Now they are easing. Now, if it turns, so to me, this is the critical question of soft landing versus hard landing. If wages growth can broadly continue to ease back toward what we saw, that 3 to 4% pace prior to the pandemic, concerns with inflation in the US should largely evaporate, because as I said, goods is rolling over, housing's rolling over. So if wages roll over, it means that services ex housing should also eventually roll over, and the RBA and the Fed can basically, not have to drive the economy into recession. If it turns out wages remain sticky and service inflation remains sticky, and overall inflation therefore holds above it doesn't look like it's going to trend back toward that 2% target, then the Fed would have to conclude, well, to get wages down, we need to get the unemployment rate up, which means we've got to jack up interest rates and slow the economy by more than we've seen to date. So it really, boils down to this wages story. But, the trend, is encouraging. It has been declining, even though we've had no decline in the unemployment rate as yet. So just as, again, but I'll get onto this. So these are the cases for the hard landing, and that inflation is high. We've never got it down in a material way without a recession. At the moment, core inflation, service inflation is still high, supported by high wages growth. So that would suggest you need some increase in unemployment to bring down pace of wages growth according to the traditional sort of Phillips curve type relationship. Higher unemployment, workers get less bargaining power. It means they demand, less able to demand higher wages, and wages come down. That's the theory anyway. Now, the Fed are forecasting a mild increase in the unemployment rate of 1% over the next year, going from 3.5 to 4.5. Now, that could be a soft landing or a softish landing, or at least a very mild recession. The only problem with that theory, and this again is the argument for the hard landing, is that historically, every time the US unemployment rate has gone up by 0.5%, it's tipped the economy into recession. So we've, again, just to repeat, we've never had a 1% increase in the unemployment rate in the US without it tipping into recession, and without that increase in unemployment eventually becoming somewhat higher. You can see, so this chart shows you the increase in unemployment on a 3-month moving average basis from its 12 monthly low. So whatever the low was in the past year, this is the increase in the unemployment rate from that low. And you can see, and the grey areas are US recessions as defined by the National Bureau of Economic Research. You can see that every time that rate has ticked up above half, you've been pretty close to the month in which the NBR is called a recession. So that's point one. And point two is every time it has crossed that 0.5% threshold, it's never stopped there. And in fact, it's often gone a lot higher. In 1990, it went up 1.5%. In the GFC, it went up about 1.5%. And that was on a rolling relative to its 12 monthly low. I will point out the total increase in unemployment over that time was higher than that. That's only the increase from the 12 monthly low, but obviously the absolute increase was somewhat higher in both of those periods. So that is the challenge of the idea, or maybe we just need a small increase in unemployment that will help bring down wages. Problem is, once you get enough negative momentum in the economy, historically at least, it's tended to get weaker, get a lot weaker, and tip into recession. So that is the hard landing argument. Now, the argument for a soft landing, this is where there's some good news on the horizon. As I said, that this breaks down US core inflation into 3 components: core goods, housing, and that one I showed earlier, services ex housing. So goods are moving back. Goods is, I think that orange line will continue to trend down, and basically we'll be in a period of probably flat to low goods inflation as we saw prior to the pandemic over the next little while. Housing, meanwhile, is also rolling over, and if you look at what's happening in the rental market with rents flattening off and easing somewhat, with a lag that flows through to housing, and so that annual rate, which is currently 8%, should continue to progressively fall over the next 3 to 6 months as well, maybe back to 4% or even less. So we're really talking about this services area and wages. Now, just on that front, if you look at core services, again, it's not convincing at this point. This is the 3 monthly moving average of the monthly increase in core services ex housing, taking a 3-month moving average and annualizing it. And at the moment, that annual rate is 3%, which is almost back to what we saw prior to the pandemic. Now, as you can see, it's been jagged, so it has touched 3% a few times, only to thereafter bounce back. So we can't get too excited at the moment, because there's a risk, given what we've seen in the past few years, that it could bounce back again. But at least at the moment, over the last few months, services inflation ex housing in the US has been relatively benign as well. And if we get a couple more months like that, that will be something different to what we've seen in the last few years. And it would suggest, maybe inflation is starting to ease, even in the services sector. And on the wages front, now, one difference between today and 2019, when the unemployment rate, so again, I just want to quickly highlight, go back to this chart first. So if you look at 2019, you can see wages growth back then was running at 3.5 to 4%, whereas today it's running at 5 to 6%. Now, if you go to this slide and you look at 2019, and I've got it in highlighted in that circle there, the unemployment rate back then was as low as it was today. So you are able, history shows you it is possible to have wage inflation at 3 to 4%, which is consistent with inflation being at 2%, with the unemployment rate as low as it is today. Now, why is wages growth higher today? Because if you see, job vacancies are higher, so there's a greater labour mismatch. So the level of outstanding, businesses seeking workers is still higher today than it was in 2019, which helps to explain that higher pace of wages growth. But there's two things happening. As you can see, the job vacancy rate has been falling, and I think that's been that's been falling without, at this stage, any increase in the unemployment rate, which was quite different from what we saw during the GFC, for example, here. So once the vacancy rate started falling, it was almost at the same time the unemployment rate started rising. And similarly, back during the dot-com bubble, once the job vacancy rate started falling, it was almost exactly the same time the unemployment rate started rising. So historically, you've never been able to reduce this demand for workers without having some increase in unemployment. So far, at least, we've had a major decline in the job vacancy rate from very high levels with, as you can see, no increase in unemployment. Now, that has been the big surprise to everybody. Now, why many were calling a recession, but it hasn't happened yet. And the other point to note is, yes, job vacancies are higher than what we saw in 2019, but there's been an upward trend in that this measure of vacancies as a percent of the labour force have been trending up. And so maybe the correct way to think about this is that it's not the absolute level, but it's the deviation from trend. On that front, you could say they're almost back to their trend level as they were in 2019. And so, maybe we don't need a significant further decline in job vacancies, and maybe if they hold around current levels, we may get, wages growth continuing to moderate. The other element of this is that why job vacancies have fallen without the economy having to slow is that some of those vacancies have been filled by an increase in labour supply. So labour force participation in the US, which was slow to recover from the COVID lockdowns, has bounced back over the last 6 months pretty nicely. And also, equally importantly, immigration has started to pick up in the US as well. So job vacancies have fallen not just because businesses have reduced their demand for workers, but they've been able to find the workers they want. And so that degree of labour mismatch has narrowed, consistent with some moderation in wages at the moment. So look, these are all hopeful signs. There's still a risk that this remains sticky and the unemployment rate does eventually start moving higher. But I've been anticipating the US would have to tumble into recession. Hasn't happened yet, and things have been moving in an encouraging direction. So we'll just have to wait and see on that front. Now, what does all this mean for markets? Firstly, first and foremost, equity markets have been rallying, broadly speaking, since late last year, and that rally has continued over recent months. And so here is the S&P 500. It sold off through the first 3 quarters of last year. It has bounced back nicely. Bond yields having increased strongly through 22 on the back of RBA central bank interest rate increases, have broadly moved sideways. Yes, they've ticked up of late toward the top end of their range, but they haven't really convincingly broken above that range. So broadly speaking, bond yields have been moving sideways. We've had the US dollar, I guess, flat on a weakening trend. And we've had, oil prices after that initial surge with Russia's invasion of Ukraine come down. So these are all, risk, positive for risk in that, a weaker US dollar is good for global markets, and as is, the fact that, bond yields have stopped rising after that big increase through 22. Australian market, look, our market has bounced from late last year as well. It's been a little bit more choppy. One of the factors in Australia, overall earnings growth has been pretty flat. We've got commodity prices coming off, energy prices coming off, which tends to hurt the energy and resource companies in Australia, which have a higher weight in our market. So it's had a bigger drag on our market. So you can see it's had a less choppy path than the US market. So the US market fell and then rebounded. Our market, yes, it's rebounded, but it's been a little bit haltering at this point. Everything else broadly similar. Aussie dollar trapped in this range. It's ranged around about the mid 60s to the high 70s. Iron ore prices haven't collapsed. We haven't really talked about China, but China's recovery has been faltering. Markets are still hoping China's about to unleash a fiscal stimulus package to support its economy. So we haven't really seen a major collapse in commodity prices as yet. But we'll wait and see whether China ends up doing that. They are concerned about the high levels of debt. But broadly speaking, this is what's been happening in our economy. Bond yields haven't fallen, but they've been, range bound. And as I'll get into in a minute, if you think central banks are close to finished, this is pretty good buying. And if you can buy 10-year bond yields or long-term bond yields at current levels, I think we're certainly close to the peak of rates over the next couple of years. So just on that, this is what the market is expecting for the RBA. Really, they've basically, the market's pricing in a 50-50 chance of one more rate rise, and thereafter a fairly flat outlook. And at the moment, I wouldn't quibble too much with that. I think there's probably a case for one more rate rise, particularly if we see some bounce back in consumer spending in the short run, ironically on the back of weaker inflation, and also maybe a bit more of a bounce back in house prices and ongoing resilience in the labour market. If we see these sort of things, and particularly if we see any upside surprise in inflation with the monthly CPI, I think the RBA would probably raise rates at least one more time. But bigger picture, given the slowing of the economy, given the slowing of inflation, I think we are close to done on the RBA front. And here are the arguments for and against further rate. As I said, inflation is high still, but it's easing. The labour market is tight, but the forward indicators suggest growth is slowing. We do have some cost pressures still ongoing in the rent area and electricity prices, but other areas are moderating. Inflation expectations in the short run are high, so consumer short run inflation expectations are high, but longer term measures of inflation expectations are still contained, which is pretty positive. And also, as I pointed out, if you look at countries like the US, there are signs of easing global inflation as well. So it's a push-pull, and on balance, I think the case to pause is growing relative to the case for further hikes. The Fed's similar. The markets are basically pricing at a 50% chance of one more rate rise, and thereafter, anticipating more aggressive rate cuts next year. Particularly given the Fed have raised rates more aggressively than the RBA. So they're at over 5%, we're at just over 4%. So given it's a higher rate, the markets are more inclined to price in rate cuts. And again, if inflation does moderate and or we get a recession, certainly if we get a recession, I think we'll get rate cuts in the US next year. But even if we don't get a recession, provided inflation continues to ease, and as I said, if the wage inflation eases, then the Fed could well cut rates next year as well. So, you're either going to get the Fed inducing a hard landing, or it won't induce a hard landing because you get a soft landing. And if you get a soft landing, the Fed can probably still cut interest rates because inflation will be moving in the right direction. And I've just got just in the interest of time, I won't go through this too much, but basically I'm pricing in. What's important is that even if central banks raise rates once more, as I've sort of penciled in there on the orange line, both in the US and Australia, what's important for longer term for your bond yield forecast is what the markets are then pricing in for rate cuts 12 months forward. So this is what you see down here. So basically my expectation for Australia is that the RBA will raise rates 25 points more, but by the end of this year, the market will be pricing in 75 points of rate cuts in 24. So that's what they expect on a 12-month forward basis. And if that is right, the bond yields, 10-year bond yield should be around about 3.5% at the end of the year, down from, we're just over 4% at the moment. And then as we get through next year, I actually got the RBA cutting rates and the market pricing in more rate cuts. So basically renormalization, a move back toward a normalization of rates, and that can be consistent with bond yields declining. Share market, look, there are encouraging signs of the share there are reasons for the market to have rallied. So basically, the equity markets have been rallying on the hope of a soft landing since late last year, and there's been no reason at this moment to dissuade the market of that view because the US economy has been resilient and inflation has been broadly falling. Problem is that earnings growth has been flat over this whole period. Markets have scaled down expected earnings growth. So all of that rebound in the markets have been the price to earnings ratio going up from just under 16 to now just under 20 in the US. And you can see these are the values of the market's price to earnings ratio in the US on a monthly basis. So monthly observations of the PE ratio and 10-year bond yields. broadly there's a negative relationship. But you can see at the moment, 10-year bond yields in the US still around about 4%, and we're at the top end of the range of PE valuations we've seen with bond yields at this level. So you can see the market is looking pricey given bond yields where they are. Now, this is where we were in COVID. The market did get expensive. It was pricing in a recovery. Yeah, basically the market recovered even though earnings hadn't quite recovered because the market was hoping for a V-shaped recovery from COVID. It turned out the market was right, and we did get that V-shaped recovery. So the market didn't correct even though we did get, you know, for a time high valuations. This was the dot-com bubble in the late 1990s. Where valuations were very high, and not only that, the 10 bond yields were a lot higher, 6%. So that was clearly a case of overvaluation, and the markets obviously did correct. As those who know their economic history, we had the 2000, crash in the markets from a point of overvaluation. But bottom line here, the market is rich. The market is rich, and if you don't get, so it is even without a US recession. It is, I think, vulnerable to a correction at least, of the order of 5–10% on any number of reasons. Just given with the rebound that we've seen, but if we do get the recovery, if the US avoids recession and earnings can start to recover after having been weak this year, then markets can probably continue to grind higher with earnings recovering more so than earnings growing stronger than the market, so that the price to earnings ratio can come back down again. And also with the Fed, cutting interest rates next year, if that pans out, that would be supportive of the market as well. So it's expensive. It's pricing in a lot of good news, but we could get good news as we got during COVID. But it is certainly vulnerable to anything less than very good news at the moment. I'll just conclude on some of the trends we're seeing in equity markets. Obviously, this is the relative performance of different exposures to the global market. So these lines going up means that these markets are outperforming the global market. It's not an outright index; it's the relative performance index. So a couple of points to note: after the sell-off of the technology area and the quality, so things like the NASDAQ last year, so growth technology got hit by the increase in interest rates. It has been outperforming, broadly speaking, since late last year, and that's more or less continued. But if anything, what we've seen in the last month or so has been a broadening of that rally to areas outside of technology. So things like US equal weight has started to at least stop underperforming, and Australia's fundamentally weighted Australian ETF, QAUS, it's one of our ETFs. It tends to have a bit of a value exposure, has started to outperform in our market as well. So really, I guess to summarize here, we're seeing a growth in technology has led the rebound in the markets. And at the moment, with the market still becoming more confident that maybe we'll avoid a recession, we're seeing that recovery broaden to other areas of the market outside of the tech and growth area. I will leave it there and open it up for questions.
Thank you, David. And there's certainly plenty of questions coming through. I'm just trying to get across all of them, but one that's come up a couple of times is the probability or the impact or what would be a black or a grey swan event to sort of take away from your base case. What commentary do you have there?
Look, obviously the worst thing we could see now is a bounce back in inflation. No, I do know that oil prices have started to lift a little bit. We've had Saudi Arabia affirm its recent production cut. We've had Russia cut back its production as well. So oil prices have lifted a little. We had the grain deal where Russia was allowing, Ukraine to still export its grain to global markets. That deal fell through. So we're seeing some shortages in the grain area and food and with food prices. We've got the El Nino, weather events could disrupt production in the Northern Hemisphere. And so if we got a rebound in food and energy prices and headline inflation started bouncing back up, That would be very uncomfortable for central banks, because they'd worry that it would feed through to inflation expectations. And so, that would be a bearish development for both bond and equity markets. Obviously, we're watching, I'm sweating over the US wages numbers. I think that's the most critical indicator in terms of global markets. If wages growth continues to moderate, happy days. If it doesn't, then the Fed's on the hook to do more and ensure a slowdown in the economy. So that's certainly pretty critical. What other black swan events? I mean, China, again, we only briefly touched on China, but, the Chinese recovery post-COVID is certainly, I guess, faltering. We're getting a bunch of weak economic data. China has a high youth unemployment rate. And, something we've always worried about is if the economy does start to falter, and certainly if you do get social unrest, that they may, rattle the sabers and start to talk aggressively about invading Taiwan, or, you might get some sort of military diversion. So that's a potential black swan event coming out of China as well. So they are the things I would sort of highlight at the moment.
Thank you. I might combine two into one here, but you spoke about China and potential for a recession, but broadening that out, so China or the US going into a recession, what impact does that force Australia's hand, I guess, for lack of a better word, in terms of going into recession, or not necessarily the case?
Yeah, good question. Look, historically, every time the US has gone into recession, we've certainly been affected, and we've had again, in Australia, we define a recession as 2 quarters of negative economic growth. Probably a better measure is, I would say, an increase in the unemployment rate of, say, 1.5% to 2% within a year. And historically, every time the US has had a recession, we've had an increase in the unemployment rate of at least, 1.5% or so. So yes, if the US does go in a recession, I think you'd see businesses around the world be cautious, cut back their investment plans, their employment plans. And obviously, if US and China went into recession, I mean, a recession in China wouldn't be negative growth. It'd probably be, 2% growth rather than 4 or 5% growth. That would obviously, be negative for commodity prices. It'd be negative for the Aussie dollar. So I don't think we would escape. Obviously, the RBA would help out. They would be cutting interest rates, but that's what they always do if you go into a recession. So I don't think we could avoid a downturn if the US did go into recession, notwithstanding the fact that the RBA would probably quickly change its tune and start cutting interest rates.
Great. We've covered US and China, the two major economies, but another one that's generating a little bit of interest at the moment, and there's a bit happening there, is Japan. Couple of questions on concerns for Japan at all, or just any commentary on the Bank of Japan tweaking the yield curve control and impacts that might have moving forward.
Yeah, so just on, I mean, I've got a slide here. You can see that, in fact, the Japanese market since late last year has been one of the standout performers. So this is the orange line here. So it's the relative performance of the Nikkei versus the MSCI All Country World Index. So you can see it had a very strong period of outperformance. Look, it is choppy. It was a period of underperformance for a while, and it's pulled back a little bit lately. But, I think foreign investor interest in the Japanese market is certainly picking up. It does look cheap relative to the US market. You've got companies at least expressing interest in improving shareholder return on equity, reducing lazy cash on balance sheets. We haven't seen a huge amount of if you look at, I read an article only recently about changes to Japanese profitability and whatnot. They had, despite a lot of the talk, there hasn't been a lot of evidence of it yet. But there are, policy is encouraging companies to do that. Just on the Japanese yield tweak, look, I mean, end of the day, the Japanese don't want a strong currency. So I don't think they'll do anything too aggressive on interest rates that would see the yen, weaken a lot, because their exporters don't like it. I think the main reason they're keeping this zero interest rate policy is to keep the yen weak. it's not really to think that that's going to support the economy. Or, well, it does indirectly support the economy, but they've had a policy of keeping bond yields at at 0.5% long-term bond yields for a long time, which does seem completely out of kilter with what we're seeing globally. US 10-year bond yields are now 4%. Australian bond yields are at 4%. We did have yield curve targets at one point as well. We've ditched those. But again, I think Japan are now talking about increasing that range to something above, I think the exact word, I can't remember the exact words, but basically something above 0.5%. So maybe drifting between 0.5% and 1%. Obviously watch and see. Where there was a bit of a surprise to markets. We had a couple of days of volatility in markets on the back of that. We did have a mini surge in bond yields for a time. They did come back after that. But I would be surprised if we see major changes in the Japanese approach and a major increase in JGB bond yields from where they are at the moment.
Okay. Number of questions coming through on currency. Maybe just your view on the Aussie versus US over the next 12 months.
Look, at soft landing, hard landing. I hate to boil it down to that, but I mean, I have been bearish on the Aussie. But Aussie dollar's been in a messy sideways range for a while. It's been in this mid 60-cent range. It hasn't broken out much above 68 cents. It hasn't broken down much below 64 cents. It's had a few attempts, but thereafter it sort of gravitated back into that area. In fact, I'll just quickly show the Aussie dollar. I do have it here. There it is. So here's the Aussie dollar here. We did have a rebound. This initial soft landing hopes saw the Aussie dollar rebound, but thereafter, it's basically fallen back below 70 cents, and it's been in this choppy range. So I actually, to be honest, I think it's going to remain range bound. I don't have a big call. If you get a soft landing and global growth rebounds strongly, it's probably going to break to the upside. If you get a US recession, it will break to the downside. But in this indeterminate period, it's going to remain this choppy range. Now, China's sluggish recovery from the COVID lockdowns is not helpful. But we haven't seen, despite all of that, we haven't seen a big collapse in iron ore prices. I mean, they're still chugging at over $100 a ton here. So despite all the concerns about China, I mean, it's still holding up, and as a result, we haven't seen a collapse in the Aussie. So I don't have a my call, when I was more confident the US is going into a recession, I would be more confident that it was going to break to the low 60 cents and even break under 60 cents. But for the reason outlined, I mean, I'm less confident that we are going to see that recession, which is ultimately good news, but ultimately potentially good news for the Aussie as well.
Dave, speaking of chance of a recession, and I don't want to press you too much here, but earlier in the year we presented a case that I think was 50% chance of US hard landing or recession. Has that materially changed? And there's just a number of questions saying, what is the percentage chance now attributed to?
What is the percent change? Look, I would say it's probably on a 12-month view, I would say 30 to 40% now.
Okay.
So it's not zero, but it's probably. Now, that's not to say you'll never get a recession. I mean, the unemployment rate in the US is still very low. I mean, what is unlikely is a period of strong growth in the US. I mean, we may avoid a recession, but we're not going to get above trend. Well, we can't. The US can't afford to grow at an above trend pace, given where the unemployment rate is and given the lingering tightness of the labour market. So at best, we're looking at growth of about 2%, which is about trend growth. And is that enough for equity markets? I mean, again, I think markets have priced in a lot. I think markets, after having that rebound, are probably going to be a bit more sluggish going forward, even in the absence of a recession, because the absence of a recession, has largely now already been priced into the market. But I said, I have to, as John Maynard Keynes said, when the facts change, you change your mind, and the economy has remained remarkably resilient, and we are seeing signs of an easing in core inflation, wage inflation, and the degree of job, labour shortages in the US without a recession. So if those trends continue, happy days.
Well answered. A couple more. One I can answer. Someone's just asked about where dividend yields are sort of stated. Go to the individual fund page on our website. That'll all be up to date and available to be viewed. And David, we might end with just one. Any areas that you feel, there's value that's not priced in, or unloved areas that could perform well over the next 12 months?
Well, I mean, I think the standout buy here, and again, I often ask this question, in meetings with various investment seminars and meeting with, many of our near and dear financial planning clients, many of you that might be out there at the moment. They say, if you had, $100,000 to invest, where would you put it? And I would say AGVT, which is our long-term government bond ETF, because, I think yields are going to, if you think about it, the two most likely scenarios over the coming year will be either a hard landing, in which case bond yields fall because central banks cut rates, or a soft landing, in which case inflation can still fall. Banks may not cut rates as aggressively, but they're probably not going to be raising rates. And so you're getting decent yields now on bonds with a likelihood that bond yields will fall from where they are now as central banks move toward cutting rates and renormalizing rates, which are at above average levels. Equity market, broadly speaking, I mean, you've got to be positive on the equity market to have a positive view in an outright sense in any area of the market. But there's still a 30 to 40% chance that we may get a hard landing. The central banks need to be aggressive, or that the economy just does tumble of its own accord, in a way that we haven't seen yet. So I'd be more neutral on the equity market here. I'm not as particularly given the valuations. But if you did want an area of the equity market that is likely to outperform, I think some of these areas outside of the very hot NASDAQ area, like NASDAQ has done so well. So technology has done very well, even without interest rates falling all that much at the moment. And I think some of these laggard areas, like S&P equal weight, the ETF for that is QUS. So it's the S&P 500 index, but equally weighting all of the companies. So it reduces that big tech the top 5 or 6 tech companies now account for, you might know, Blair, off the top of your head, is it 25-30% of the index?
Yeah, top 7, almost 30, I think.
Yeah, so it's a very large concentration risk in the technology area, and some of these other areas may catch up. It would be my call. Also, the Japanese market, it's had a bit of a pullback, but I think we're seeing growing interest in other areas to invest, and it certainly looks cheap. The other thing is, don't forget all of our thematics. So RBTZ, which is global robotics and artificial intelligence, it's had a great. That is a tech area, but it's a little bit beyond, a little bit more niche than say just the NASDAQ. So obviously everything artificial intelligence has attracted a lot of attention of late, but the onshoring trend we're seeing as well is boosting demand for robotics. So RBTZ is an ETF that is well placed in that area. Hack, of course, is the other one. Cybersecurity. The trend toward companies and governments having to spend more and more money on cyber protection is not going away. So those companies are very well placed. But they are long-term, I guess, growth thematics. In an environment where we potentially avoid a recession, I think they will continue to be well supported.
Fantastic. Well, look, I think we are right on time. So, David, thank you very much for today's update. Certainly got a lot out of that. But also, thank you to everyone that's joined today. Some really great questions. And as I said previously, a copy of the recording will be made available to you via email this afternoon, but will be available immediately after on our YouTube channel. So
I might just, sorry, Blair, before you sign off, we probably do have a lot of other questions, right? And so we will endeavour to answer those in written form, maybe group them together, and how do we send that back out? Do we? Email it back out. Yeah. So
fantastic.
So if you've got a question and we haven't answered it, we will endeavour to answer it and give you a response.
Thanks all for your time.